our clients ask us a lot about getting into retirement and how to pay for different things. Or a lot of times we just get a phone call that says, hey, I need to take out $30, $40, $50,000 from my account to pay down my car or to buy a new car, to replace my car. It's getting old. Or, maybe I've got another 50,000 or 100,000 left on my mortgage and I want to pay that off. So I wanted to go through a couple of scenarios and give some, some things to think about that we tell our clients. So, the first thing that we try to educate people on is the time value of money. So share with our audience exactly what is time value of money.
Yes, the time value of money definition is just the time is a financial concept that holds that the value of a dollar today is worth more than the value of a dollar in the future. So this is actually true because of growing inflation. We know inflation now, it will lessen the value of what the dollar today will buy in the future.
Yep. So there's also, with time value of money, there's something real called opportunity cost. So whenever you use your cash up today to buy an asset, a car or a home, you don't have those dollars growing for you in the future. So the opportunity cost is the difference between what you could make if you left that money invested. Let's say that you can, the markets have averaged 12% over time. We're not going to even figure on 12% because if you follow our strategy, you're going to have a diversified strategy. You're going to have some fixed income and things like that. So let's just assume that you could get 8% now, and you're looking at buying a car, and you can either use up your dollars to pay for that car, and if you have to take it out of a retirement account, you got to pay taxes on it and a penalty if you're under 59 and a half. Or you could finance that car maybe at, say, 6%. Well, the difference between what you would pay in interest, the 6%, and the 8% that you could potentially earn is your opportunity cost. So not only are you giving up some dollars, but you're giving up the opportunity that to get the earnings that money would reap for you if it stayed, or likely reap for you if it stayed invested. So this is true with homes too. Jason, you want to go over some of the things that we talk about with our clients when they consider withdrawing money from their portfolios to pay off their homes?
Absolutely. So with the home specifically, we get these questions from clients that are just asking, hey, I'd like to just pay off my home a little bit earlier than expected. We just want to remove all of our debt. That's wonderful that's the mindset, the fear of money and, owing, the Bible talks a lot about that. But with us, when we look at the retirement assets, we do have to factor in the taxes with the qualified account. So that's something built in there that we have to be sensitive to. But also at the same time, if the assets are actually helping them if they're taking income from these assets, if they're able to make the mortgage comfortably with their other fixed, Social Security or pension or the income sources that they might have, then why remove that block of money when that can be working for them? Because once you remove that block of money, you have lesser total account value that can work for you for the future, because expenses are only going to go up because of inflation. The same expenses you pay now, in 30 years, you're going to be paying those same expenses, even if you remove all the debt. So that's really how we like to break down retirement lifestyle, is to your income meeting your expenses. And what can you change when you're not working anymore? Only your expenses to a point.